Hello, welcome to this overview of the ESS BIZTOOLS Accountant's Minute, edition 390. And this is our podcast, and I'm going to guide you through our final Accountant's Minute for 2024. The title we selected was Guide SMEs Through Challenges. Your advisory role matters. Let me just repeat that. Your advisory role matters. Obviously, the Accountant's Minute podcast is directed at accountants, bookkeepers, and business advisors. And I suppose anyone else that's generally delivering services to SMEs. SMEs are facing challenging times. We've got high interest rates. We've got high inflation. We've got high levels of business failures. We've got warnings coming from the Australian Small Business Ombudsman. We've got warnings coming from the CEO of MYOB, Paul Robson, based on their analysis of 1,000 SMEs and his observation that many of them lack fiscal management skills. So whose responsibility then is it to supply that information? I think it's logically accountants. And we've got the warning issued by Gerry Harvey, one of Australia's outstanding business persons and personalities, over 60 years in business, who has warned that the next 5 years he believes is going to be very tough, and in fact in 5 years' time he thinks it could be extremely tough for all business operators. So what are we going to do as the key advisors to SMEs? Because I can't think of any other professional group that's out there in the marketplace that's going to supply services to assist SMEs to survive and thrive. Accountants who have been providing taxation services to their clients over the years have done a great job. But the market needs more. The failure rates are identifying this. They need more information. And I think what we need to do is to sit down and move back a bit and reflect on what your role would be if you were employed full-time as an accountant or as a chief financial officer in a larger business. What do you think you would be doing? So why not grab a pad and start writing? What do you think you would do for 38 hours and possibly more, 45, 50 hours a week, working for that business on a full-time basis? What would you do on a Monday, Tuesday, Wednesday, Thursday? What would you do at the end of a month? What key documentation would you be involved in? And I think you'll find that what I'm going to share with you today is the sort of things that you'd be doing. Now let's wind back to key clients you're currently acting for. None of them are large enough to justify the employment of a full-time accountant, but they do require additional services. I think every business starts as a small one and grows. They do need taxation advice. That's a constant right through the evolution of business. But they need financial and commercial advice as well. And who is giving that to them? Constantly, so that the client knows that this is part of the service. It's not a one-off. It's not something that they worried about all weekend, whether they would pick up the phone on Monday and talk to you about, because they don't know whether it's part of the service you're providing. And unfortunately, this emphasis on tax returns has created an environment where thousands of SMEs don't know whether their accountant is able to supply advice on anything else other than taxation. And it's not the taxation areas that they need assistance on. It's on financial and commercial issues. So let me share some of these with you as we go through and think about it today. I think it all starts with a 52-week business enhancement system, because that is really then identifying what this is all about. Out there in business land, your clients are operating 5 days, 6, 7 days a week, virtually every week of the year. And even when businesses where they shut down for annual leave and have 3 or 4 weeks off and everyone goes on holidays, there's still costs being incurred. But you could call it a 48-week enhancement system if you wanted. And even in businesses that have off seasons. I was involved when I was in the public company as chief financial officer and company secretary of a major meat corporation, and we definitely did have off seasons in some of our major meatworks. They only operated for about 7 or 8 months of the year. And I can assure you the cost budgets, which we used to have internal fights over every year, trying to restrict what was going to be spent in the off season, was important. So making sure you control what was happening in the off season was nearly as big a challenge as what was happening on a day-by-day basis, which was really what our emphasis was on when those meatworks were in operation. Because otherwise, the $500,000 off-season budget could get blown out very quickly. And you might say, well, what happens in the off-season? There were all sorts of repairs and maintenance. There were all sorts of changes. Issues had been identified by the manager of the works, by the foreman, of changes they wanted. So all of this, in my opinion, is saying to us that the businesses do operate 52 weeks of the year and that they need systems. So it starts with a due diligence review. I learned many years ago, having been in an accounting firm, joined a public company, become the chief financial officer and company secretary, but years later went back into accounting, that the knowledge of the accountants that I was employing or I'd gone into partnership with was not as deep as what the knowledge that I was wanting to obtain about the clients. And that came because in the public company environment, I knew a lot about the business. I had to. And our various locations. And I think you also need to develop that knowledge. And that's why we say you start with a due diligence review. And I think you should do that for every client as you start them on this journey of helping them on financial and commercial advisory services. The due diligence review is looking at internal control. It's looking at risk management. It's looking at debtors. It's looking at inventory. It's looking at who the suppliers are. Where are the suppliers located? What could happen to the cash flow if something goes wrong with the receipt of supplies? Or is the online management trying to increase the inventory of materials that they're bringing in from suppliers because they're worried about supply difficulties? Sure, that's their job, but your job is to worry about the cash flow in this overall business. And to do that, you need to have this appreciation of what is happening in this overall business. So you go through that process. It's only 1 to 2 days work. You go through that process and you understand it, and perhaps do some spot checks during the year. Maybe do a partial review in 12 months' time. Just make sure everything's functioning properly. And then we're ready to look at business planning. Now, business plans are vital for all types of enterprises, whether they're church groups, sporting groups, the local golf club, or businesses. There needs to be a plan. This is what we're going to try to achieve. This is how we're going to do it. This is the manpower we need. This is the amount of money we need that's developed. But please don't say to the client, oh, I'll prepare the business plan and go off back to your office and sit down and write a business plan. Anyone can do that. We need the business plan to have the fingerprints all over it of the leadership team, because it is their document. They are the team that are going to implement it. Now, you might, if you're offering a CFO role, be part of you are part of the leadership team, but you're not the only one that's going to implement it. You don't want them sitting back saying, oh, no, we didn't really get involved in that. No, I don't know what that discussion was about. No, you approved that and I didn't know anything about it. You want them involved. In fact, I think we should be saying that the signatures on the business plan are not only the CEOs, the whole leadership team, the people who contributed to the development of the document. And one of the key components of the business plan is the action plan. That's where it's important. Who's going to do what? Because a business plan is a futuristic document, isn't it? It's not recording the past. It's saying, well, this is where we are. That's what we are at present. This is where we're going to go. So that the action plan is very important. So that at each month's leadership team meeting, the action plan within the business plan is a key agenda item. And the leadership team looks at where they are because the action plan's got a particular comment, by whom, by when. How's that going? And the CEO should be thumping the table on that to make sure that all happens. So we've prepared the business plan. We've got a document. The leadership team signed off on it. Where do we go from there? Well, we go to predictive accounting reports. Not the other way around, the predictive accounting reports first and then the business plan. The business plan should set the parameters. We've now gone into the predictive accounting reports. And there are key components of it also, of course. The first one is budgeting. And there should be a budget for each individual business operation. So if your client's got 3 retail shops, a warehouse facility, a garage sort of delivery facility, an office, all separate P&Ls. Why? I had someone ring me one day and say, Peter Towers, why do you keep on saying you've got to break these down? Because we want accountability. There is obviously a separate manager for each of those 3 retail shops. There's a separate person running the wholesale business, running the workshop. We need to have financial accounts that are going to go back to them that are showing how they've run their responsibilities. It's part of accountability, so they can see the result. You put it all together into a consolidated report, no one has got any responsibility. Oh, nothing to do with me. No, that wasn't my area. Over the years, I've been involved in some major business reconstructions. And the biggest problems have been where people have put everything into one profit and loss account. I had one instance where there were 18 activities within this business. And it had all been put together in the one P&L account. Thank goodness the internal bookkeeper had recorded which section the sales related to and a lot of the purchases, and had even broken down the labour. She wanted to prepare individual accounts. That was very obvious, but had been overruled by senior management. And I got brought in because suddenly this business that had a $20 million turnover overall was facing financial difficulties. It had been trading very successfully for years, and then suddenly in 12 months it's really dipped. And no one knew why. So I went in with one of my accounting offsiders, and we said, well, this is going to be interesting, but we've got to try to reconstruct what is happening on individual businesses to try to find out where the problem was. Otherwise, just 18 sort of businesses and a $20 million turnover, it really meant nothing. Meant nothing. So it took us a couple of weeks. Thank goodness, as I said, the internal office manager had kept far more records than I'm sure that the directors realised that she'd been keeping. And we reconstructed on some spreadsheets, worked round the clock, and reconstructed as best we could with the key data that we were able to get hold of, what the results were for these 18 activities. And surprise, surprise, the biggest problem was the favourite of the business. It was the biggest activity. And when I sat down to brief the CEO, he didn't believe me, but after about 3 hours of discussion, he finally did. And he then said, well, we'll have a team meeting tomorrow morning. I said, okay, I'll be there. And they normally started at 7 a.m. I got there at 7:15 and there was 20 cars there. Obviously, he'd got on the phone and got them there at 5 a.m. And after about half an hour of him generally blasting everyone, someone said, did you change the pricing because of the transport route was changed? And he said, what? What changed in the transport route? And what had happened, this company had trucks going everywhere, and the TARE bridge weight allowance on a particular bridge had been changed by Main Roads Department. And that meant they had to divert. And they had 12 trucks a day going backwards and forwards, going over this, traditionally been going over this little bridge, that suddenly got diverted. It was a 300-odd kilometre diversion. No one had told senior management, apparently, especially the one that was issuing the invoices. No one had done anything. And this had gone on for over a year. Unbelievable. Fuel costs up. So there was no analysis being made of any of the key performance indicators. They were non-existent. The business metrics, non-existent. This is the role of accountants, to help businesses. And this is why I'm so emphatic that we need individual business operations in the predictive accounting reports. Then we need to go into the key drivers. Now, the key drivers are the key sub-accounts, their inventory, their debtors, creditors, capital expenditure, research and development, perhaps export market development activities to create activities in foreign markets. The reason you have them broken down to these sub-accounts is that they can be evaluated and analysed. Otherwise, they can just get hidden in the general financial forecasts and in the cash flow forecasts, and no one's monitoring them. It's vital that they're monitored. Then we go into the cash flow forecast. Now, the cash flow forecast might say, because of build-up in inventory, because of build-up of a few $100,000 getting spent to get into an overseas market, even though there might be a grant available from Australia if the business's turnover is under $20 million. What's it done to the cash flow? That's your role, to sort out the cash flow. So that's what the predictive accounting reports can do. And also the great value is they can make you the storyteller, because you will have the projected balance sheet for, say, 3 years' time. So you can sit down with the leadership team and say, now, based on your business plan, based on the predictive accounting reports, this is what this business is going to look like in 3 years' time. Now, are you happy with that? Are you happy? Or do you think some changes need to be made? Because if they need to be made, they need to be made now. Because that's where you're going to end up in 3 years. It allows you to be the storyteller. Now, hopefully it's good, happy news. You need daily reports. Businesses used to always have daily reports. It seems to have dried out. They're not something that's normally produced by a computer, because they're bits and pieces of information that someone should assemble. The best preparers of them I've always found was the secretary to the CEO, or someone, or one of the senior managers in the business. And it might be things like the bank balance, the expected receipts and payments this week, especially payments. What's it going to do to the bank balance? Because this might be the motivation for members of the leadership team to get on the phone or get into their cars and go around and collect some money, because the payments are going to be made. So we need to make sure that this information's been looked at. And it might have yesterday's sales. What was the gross profit percentage? What was the yield in any sort of processing going on in the business? Because those figures all mean something to the leadership team. And in bigger business, it is the accounting function to supply this type of information. There could be some costing information also. What did it cost to undertake a certain process yesterday? And then we move into the weekly reports. The weekly reports are very important. The big end of town does it. Woolworths, Coles, IGA, and heaps of other businesses. The whole of the meat industry prepares individual performance reports for each of their business activities each week. Normally the week finishing on a Saturday or Sunday, depends whether they trade Sundays. And by a Monday afternoon, Tuesday, for each of the operations under one area manager's control, they've got the results. They know the sales, they know the gross profit percentage, they know their used actual expenses together with other figures that they've extracted out of the budget, and they've got a result. Now, they do this so they can sit down and then evaluate. How did it come in as compared to our budget? Did we expect to get a gross profit percentage out of this retail outlet of 34%, and we've only got 21%? What caused that? And it's the evaluation of an investigation of what caused that drop that is so important. Because they may find there was an error made by management. They specialised a particular product, hasn't even arrived yet. Okay. It could be that the stock take wasn't done properly. The last 3 pages weren't added in. I've seen those sort of errors occur. It could be fraud, of course, unfortunately. Not that often, I must admit, in my experience. But it could be a few other reasons. But the main thing is it can get fixed. A problem in the system was shown. If someone had mucked up the stock take at the end of the week, well, I don't think they'll do it again, because there might have been a bit of sore ears after the manager had his say. But it doesn't stay in the system like it does in a lot of SMEs, and basically stays there for the 12 months or whatever the period is. And no one really picks it up. I think this is the greatest service we can do to our SME clients. The monthly review and reporting, P&L accounts for each of those business activities. What did we say before? 3 retail, 1 wholesale, the workshop, delivery, the office, got half a dozen, 7 P&L accounts, all going through into one balance sheet. Details of creditors and debtors, and then you can analyse the cash flow forecast. It's really bringing it all to a head, and then you could prepare a monthly report to go to the board of directors. So this is the key aspect, I think, of the type of services that accountants can provide to help your SME clients on this journey. Another area is fiscal management. Paul Robson, the CEO of MYOB, has really identified the problems that MYOB found when they interviewed 1,000 of their clients. Most of those businesses that started business, he's saying they didn't understand fiscal management. They had assumed that suppliers would give them 30 days accounts automatically. That's not right. In today's environment, who could blame suppliers saying, well, we want you to show us how good you are, first of all, so you're on cash on delivery, and in 3 months' time, we'll review it. And these people run into that type of problem. So they've been assuming they were going to get 30-day accounts. They've been told they've got to pay cash up front before they even get the stock. It's going to blow a hole in their cash flow. The other big area was apparently some didn't realise that they didn't have to offer credit to everyone that asked for it. So they had no processes for having an application for credit completed and then reviewed. They had no concept of the need to be inserting due date for payment on tax invoices, and for making sure they really understood what their customers' requirements were. When do they require those invoices? And if the customer's saying we must have them by the 8th day of the following month, otherwise payment will not be made under the next month, you need to make sure your client's got their systems operating so that this can happen. Otherwise, they wait an extra month. This can be the reason why we end up with 102 days in debtors' days outstanding by businesses that don't understand this. The other big problem that MYOB identified was people were not budgeting for the payments to the tax office. Now, the tax office was obviously told by the government during the COVID crisis to go easy on SMEs. But those restraints have now been withdrawn. And this government's spending a lot of money at present. So undoubtedly, they've told the tax commissioner they need a lot of money in. So that's my overview for you to think about as we run out the end of 2024 and start thinking about 2025. How are you going to react to these types of comments that I've been making and other people are making? My great friend Andrew Geddes, one of the founders of the Financial Management Research Centre at the University of New England, for years has been saying to accountants, you need to be supplying a broader range of services to your SME clients. Well, I really think the time has now hit us. SMEs are in strife. They do need more information than what they are receiving out of the tax return process. They really need input on financial and commercial matters affecting their business. I've been talking to you for about 30 minutes, and I have mentioned tax a couple of times, but none of the services that I talked about would be classified as taxation service for your clients. And this is the area they need assistance in. 52 weeks of the year. Over a month, they need daily, weekly, monthly reports, and then it's repeated again the next month. They need input from accountants, bookkeepers, and business advisors to enable them to survive and scale up their operations as SMEs. This is our last podcast for 2024, so thank you for your interest. If you've got any suggestions or comments, or you think I'm wrong, please send me an email, peter@essbiztools.com.au. And I look forward to talking to you again in 2025. We will be releasing our first Accountant's Minute podcast around the 16th of January. I look forward to talking to you then. Have a great Christmas, and I hope that 2025 is a prosperous and successful year for you, your professional colleagues, and your families.